So name of the reading is Multinational Operations. It's a fun reading. The story of the reading is like this, that we have a large organization which is operating in multiple economies. Okay, so let's call this organization today as Organization A. And this Organization A has a lot of subsidiaries in different countries. So let us say it has got one subsidiary in India. So let's call this organization from US. It has got one subsidiary in Mexico, one subsidiary in, let us say, Nepal. So it has got a lot of subsidiaries in Nepal. Now each of the subsidiary, it might have a different ownership. So it might have, maybe with Indian company it owns 90%. With some other companies it might have 60. Some other companies it might have, let us say, 80%. Now at the end of the financial year, Indian company prepared financial statement in rupees. But at the end of financial year, in fact, Mexican company prepared in Mexican pesos, Nepalese companies prepared in Nepalese rupees. So first question is that what currency would be used for preparation of the local financial statements. So these currencies in this reading would be called as the local currency. Now the US organization will always be preparing its financial statement in which currency? USD. So USD in this reading would be considered as the presentation currency. So we have two sets of currency here as of now. One is the local currency, the currency which is used by that subsidiary to prepare its financial statement, and the presentation currency which would be used by the parent company. Now there would also be one more currency which would be referred to as the functional currency. Now functional currency means the currency in which most of the transactions are happening in subsidiary. So think of Indian subsidiary. It is kind of an Indian independent business unit. It takes all its decision by itself. So it does all the contracts in rupees, it pays all the salary in rupees, all the customers are in rupees. So in case of Indian company, the functional currency is rupee itself. But Mexican subsidiary, it is completely controlled by the US parent company. So all operating decisions are taken by US company. All contracts are actually signed by US parent company on behalf of Mexican company. So even though it is operating in Mexico, it is closely controlled by parent, and therefore the functional currency in this case is the US dollar. So think of the subsidiaries that we have in India of foreign companies. So these subsidiaries which are only a legal representative in India, most of the transactions will happen in USD. A lot of small IT companies of US which have small setups in Pune or Mumbai. So even to the employees, typically salaries is paid in USD. So that scenario, the functional currency is USD. Now the Nepalese subsidiary, it is in a way operated by the Indian subsidiary. Is that possible? So Indian subsidiary has a higher dominance over the Nepalese subsidiary. So here the functional currency is Indian rupees. Now what is the task at hand? The task at hand is that at the end of the year, all these financial statements need to be converted to which currency? US dollar. And then the US subsidiaries or US parent companies' financial statements are to be consolidated. So there are multiple ways of doing these conversions. Now look at in case of Indian scenario. In Indian scenario, we would be converting in a way the functional currency to presentation currency, which in this example is rupees to US dollar. So if you are converting functional to presentation, there is a different method proposed. In case of Mexican, now we would be converting that Mexican financial statements to US dollar financial statements. But in this case, it would be a local currency that would be converted to a functional currency, which is same as presentation currency. So when you are converting a local currency to a functional currency, there's a different accounting method proposed. In case of the Nepalese subsidiary, first you would start with Nepalese rupee. These would be converted to Indian rupees, and then these would be converted to US dollar. So when you convert from Nepalese rupee, that's local currency, Indian rupee is functional currency, and then US dollar is presentation currency. So we will have to use a different accounting method here for Nepalese rupee to Indian rupee conversion, and we will have to use a different accounting method here, and then finally come up with the financial statements. So originally it might seem a little intimidating because there would be too many currencies and too many historical rates or exchange rates. We will have opening, closing, average, then we will have historical rates. But once you understand why we are doing this, why there's a particular treatment, then it should be relatively easier. Any questions you want to ask here? So it happens with, so think of Hindustan Unilever, or maybe think of Dabur. So all these FMCG companies, they also do business in Nepal. So to do business in Nepal, they will have a Nepalese company, but most of the operations will be handled from India. Nepalese company would only be a legal front so that you can do all the documentations and legal process correctly. So the decision making and everything will happen in India. Most of the manufacturing contracts will be in Indian rupees. And therefore, for that Nepalese subsidiary, which might be a European or American parent, but the functional currency would be Indian rupee. Yeah, any questions here? So question she's asked, what is functional currency? What is the difference between functional and? So local currency simply means the currency of the country where subsidiary is. So if it's in India, it is Indian rupee. If it's in Mexico, it is Mexican pesos. Functional currency means the primary economic environment in which that currency or that subsidiary operates. So in case of Nepalese subsidiary here, even though it is operating in Nepal, most of the contracts are happening in Indian rupees. Most of the decision making is happening in Indian rupees. It is operated in a way by the Indian company, and therefore the functional currency now becomes Indian rupee. So the currency of primary economic environment, that is the functional currency. Are we good to go ahead? Okay. So let's follow the learning outcome approach. First learning outcome here. Three currencies: presentation, functional and local. So local currency is the currency of country to which it refers. Functional currency is determined by management, is the currency of primary economic environment in which entity operates. Is that okay? So again, just to help you build more clarity on this, think of a US company. That US company has an accounting process which is currently being done in US. They are finding it very expensive. So they decided to set up a small subsidiary in India, and the entire accounting is now outsourced here. Now, this Indian company in a way has nothing to do with the Indian business environment. The only reason why it is in India, so the manpower cost is relatively cheaper, and then Indian company is billing to US company in US dollars. So primary economic environment here would be of USDs, and therefore it would be considered as functional currency. Are we good? Functional currency is usually the currency in which entity generates and expends cash. It can be the local currency or it can be some other currency. The example of Nepal. Presentation currency is the currency in which entity means the parent company, entity prepares its financial statements. Okay, so for this reading, I'm going to keep presentation currency as US dollar, so that will make us easier to think through this. Next learning outcome. Impact of changes in exchange rates on translated sales of the subsidiary and the parent company. So let us say it's a US company and they are making sales to an Indian company. Let's do it the other way around. It's an Indian company. I'm doing this so that the exchange rates could be used directly, and we have made sales to US company. Now, since Indian company is selling to US company, the billing amount has been kept in US dollar. So for example, on 21st of December, the sales was made and the amount of sales was 101,000 USD. Now on this date, exchange rate was rupees 65 for a dollar. Now this sales was made on credit, so we have not really received the cash. On 31st December, let us assume that the books were closed. That means it was the end of accounting year. On this particular date, exchange rate was rupees 69 for a dollar. On 5th of January, we actually received cash from the US company. But when we converted that to Indian rupee, now the rate had become rupees 66 for a dollar. So my question to you is, number one, what is the date on which we should recognize the sales? 21st. And what is the amount of sales that we should recognize on this particular date? 65,000. So we will recognize an amount of sales of 65,000. If you recognize a sales of 65,000, you will also have to recognize accounts receivable of the same amount, 65,000. So this is happening on 21st. Now we are closing the book on 31st. Should we take cognizance of the fact that interest rate have moved? Should we take cognizance of the fact that interest rates have moved? Yes or no? Yes? How many of you think yes? So now what you do is, your accounts receivable, which were originally 65, you will say plus 4,000. And on your income statement, that 4,000 would be shown as a gain. Are you following this? So we have a gain on account of foreign currency differences. Now on 5th of January, so let me write that here. On 5th of January, we have an accounts receivable of 69. But how much cash are we going to receive? 66. So first we will book a loss entry here of 3,000. Cash of 66, and this would be made 0. And on your income statement, we will have a loss of 3,000, and of course your cash will increase by 66,000. Any questions you want to ask him? So question is asked that 3,000 gain, should that be a part of other income or operating income? Non-operating. So there is very interesting discussion in curriculum regarding this, where they say that there is no clarity or there is no guidance in accounting standards as to whether this 3,000 gain, should that be shown as operating or should that be shown as non-operating income. Neither there is any requirement for making any separate notes for this. So of course logically it should be a non-operating income, because that forex movement wasn't a part of your core operations. But As far as accounting standards are concerned, there is no guidance in both IFRS and US GAAP regarding treatment of this 3000. Are we okay with this? Any questions you want to ask here? Why did I do what? Because when you close your book, see, these are not. So one question is, if you remember, generally with assets, we ignore the fluctuation in prices. But this is a different category of asset. With this asset, your intention is to convert this to cash immediately. So when you close your books on 31st of December, exchange rates had कुछ problem है क्या उधर? तो नीचे मत देखो बार-बार. So when you closed your books on 31st of December, exchange rate had moved, and therefore there was an unrealized gain of 4,000 which was to be booked. Right? But then on 5th of January, they moved. किसने पूछा सवाल ये? So on 5th of January, the rates moved adversely. You didn't know whether they are going to move in this direction, so you recognize a loss. No. The question Siddharth asked, it's an unrealized gain. Shouldn't it go to OCI? So this is not available for sale security. These are your accounts receivable, so we don't do that. Any questions here? Please ask anything. Do you want me to explain this again? Yes, no. 5th Jan. So 5th Jan, your accounts receivable are 69. How is 69? On 31st, we made an entry of 69. So because exchange rate moved adversely, we booked a loss of 3,000. And then we received cash of 66. So accounts receivable 0. Then on the balance sheet, we will have a cash of 66. Income statement, we will have a loss of 3,000. Chalna again. So there is an indirect 1,000 realized gain. Because previously you recognized gain of how much? 4. So now you recognize loss of 3. So there is an indirect realized gain of 1. It's just that that benefit of gain you got in the last year because exchange rate were in your favor, it went against you this year because they were against you. Any questions here? Should we go ahead? So we'll read through the theory. Foreign currency denominated transaction, including sales, are measured in the reporting currency at the spot rate on the transaction date. If the exchange rate changes, gain or loss is recognized on the settlement date. So in our example, settlement date was 5th of January. If balance sheet date occurs before the transaction is settled, then gain or loss is based on the exchange rate on the balance sheet date. And this gain is taken to where? It is taken to income statement. Once the transaction is settled, additional gain or loss is recognized if the exchange rate changes after the balance sheet date 5th of January. Are we good to go ahead? So now the true part of the reading. So there are two methods. Please give heading in your notes. Current rate and temporal method. Okay, I'm going to go extremely slowly with this. Just get good hang of the concept. Once you know how numbers are moving, it's going to be very easy. So the general feedback of candidates with level 2 FRA, that typical question that they ask, khatam ho gaya kya? Because compared to level 1 FRA, level 2 is substantially smaller and concise in size. It is a little more difficult. I'm sure you must be realizing that now. But I think once you get hold of these concepts, then you're going to find this very smooth. This is again one of those areas where if you understand the logic, you don't need to revise this again. You can just directly go and do the questions on the exam. So we have a local currency. So in our example, we will have three currencies now. US dollar, which is the presentation currency, then Indian rupee, which would be functional currency, and Nepalese rupee would be a local currency. So let us say from local currency, we are migrating to a functional currency. So read this as the Nepalese financial statement are being converted to Indian financial statements. So what method of accounting should we use here? And when these Indian financial statements are converted to USD financial statement, then what method of accounting we use here? So one easier way to think of this is that when you're shifting the Nepalese to Indian financial statements, this Nepalese subsidiary is kind of dependent on India. Agree? And the Indian subsidiary, so this is Nepalese company, Nepalese with a single E, Nepalese subsidiary is dependent, whereas Indian subsidiary, will it be appropriate to say that it is an independent subsidiary? So when you are converting financial statements of a dependent subsidiary to an independent subsidiary, okay, let's get on with the business. So if it's a Nepalese subsidiary being converted to India, since this is kind of a temporary conversion, so we would use the method here, which would be called as the temporal method. So once you think of this as a kind of a quasi temporary conversion, it becomes very easy to think from the interest rate perspective. And once you convert the Indian subsidiary to US, then this is kind of a permanent conversion. So here the method that we use is the current rate method. Please make the flowchart quickly. Are we done? Have you finished writing this? So what we would be doing is, we would be preparing total 2 balance sheets and 2 income statement, wherein we would be putting which item is to be converted at what rate. So as far as your exams is concerned, a day before the exams, you just need to revise these 4 statements. 1 balance sheet of current, 1 balance sheet of temporal, 1 income statement of current, 1 income statement of temporal. You should be able to revise most from this topic. So we are on to the current method right now. First, we'll run through the theory. If functional currency and the parent's presentation currency differ, so is the subsidiary independent? If the functional currency and parent's presentation currency differs, that means functional currency is not US dollar. Is subsidiary independent? Yes. Then all the current method is used to translate subsidiaries' financial statements. Is that fine? This usually occurs when subsidiary is relatively independent of the parent. So this is the income statement and balance sheet you need to prepare. First, let's read through this carefully together. This income statement, we would be converting into US dollar using an average rate. Okay, so average means what was the average exchange rate that prevailed during the year. So for exams, it could be opening plus closing divided by 2. On the balance sheet, look at the asset side. All the assets would be converted at current rate. Now, look at the liability side carefully. All your liabilities will also be converted at current rate. So the name of the method itself is current rate. So all your balance sheet assets get converted at current rate. All your liabilities get converted at current rate. Common stock, which was a stock, number of stocks into face value, this we will convert at the rate at which this common stock was issued, because in a way that is the amount we have received. So this gets converted at historical. Dividend paid will be converted at historical. Reserve will accumulate at the average of I mean at the average of averages. Makes sense, because every year reserve will get accumulated and every year reserve is coming through averages. So typically your reserve in a way is an average of all the previous averages, and but that would be a weighted average. For example, first year profit was 200, next year profit was 300. But this first 200-year profit, this profit must have been calculated using a rate of maybe 65. Next year maybe the rate was 67. So here on your balance sheet those reserves would be 500, which are actually made of the historical average of averages. Are you following what I'm trying to say? Now on the exams, in most of the cases that opening reserve amount is given to you in the presentation currency. Okay, so we'll do a couple of examples today. So you would see that towards the end of the question, they will tell you what was the amount of reserves in US dollar. So you just take that amount and add profit of this particular year. And then we have a CTA number here. Full form is Cumulative Translation Adjustment. And this CTA is a plug figure to make the balance sheet tally. However, that equity as a whole has to be at current rate. Can you tell me why? Because your entire assets are at current rate, your all liabilities are at current rate. So if you do not have equity at current rate, your balance sheet will not tally. So that means that CTA number comes in such a way that it ensures that the whole of equity comes at the current rate. Have you followed this? So please make this. Condition: if the functional currency and presentation currencies are not same. Historical means the date of transaction. So historical is not one rate, all of those historical could be different rates. For example, equity was issued on 31st January 2010. So the rate that existed on that day, that is this historical date. But this year in 2017 or 16 we paid a dividend. So the date on which we pay dividend, that is a historical rate for dividend. Reserve is accumulated. Reserve is not a rate, it's an average of all averages. I'll show you, we'll do an example. Have you finished writing? Sorry? CTA would be a part of equity, yes. Cumulative Translation Adjustment. So, cumulative, that means every year it accumulates. Translation means on account of forex. Translation, adjustment. Adjustment so that your balance sheet tallies. That arrow is here, average rate, and this average rate. This arrow, if it's visible here, it is for this average rate. So let me explain one more time. So we are on to the current rate or current method. Income statement, expense and income, there is absolutely nothing to worry. Everything will come at average rate. Once we have this at average rate, which means if you have the amount of profit, let us say a profit of 600 in the functional currency, just convert this at average rate and add that to the previous year's reserves. Is that fine? Then all balance sheet is to be converted at current rate. Meaning of current rate is rate on the balance sheet date. That means if you are preparing financials on 31st of December 2017, then that is your current rate. Is it fine? All liabilities would be also converted at current rate. Common stock, we will use historical. Meaning of historical is the date on which common stock was issued. So if your common stock was issued in 2008 in Zimbabwe, then the rate of exchange which existed on that day in that country is your historical rate. If dividend is paid today, then today's exchange rate is the historical rate. If dividend was paid last week, then the date on which dividend was paid, that is the historical rate. right? So which means that the common stock historical rate not necessary would be same as dividend historical rate. So historical rate means the date on which you are doing that particular transaction. Then your reserves are getting accumulated, and your reserves are accumulated how? Using the profits which are being transferred to your balance sheet every year. Is that making sense? And then finally, to make your balance sheet tally, you just put a CTA and then the process is done. So let's do an example. So we have a US company. We don't need to do that. There's an Indian company here. So I'm preparing balance sheet and profit and loss account. So this is balance sheet. The left hand side would be liabilities and equity. Right hand side is assets. So let us say we have land on the Indian company's balance sheet of, let us say, 60,000. Then we have one building which is of 40,000. We have some furniture which is 20,000. And we have cash which is 50,000. So in Indian rupee, the balance sheet total is 70, 110, 170. Please cross check. Equity is 20,000. Then currently accumulated reserves are 40,000. Bank loan 110,000. Balance sheet total 170,000. We also have an income statement. Income statement. So let me just make it vertical. This year's sales was 40,000. This year's sales is 40,000 less the COGS plus SGA plus depreciation. So all operating costs combined, let us say, is 20,000. Tax was another 10. And we had profit after tax, so that will be 10,000. Out of this profit after tax, we paid a dividend of 2,000. So these are the financial statements in Indian rupees. Financial statement in Indian rupees. Now we need different exchange rates. So first one, what is the average rate? So the rate that existed on an average throughout the year. So rate that existed on an average throughout the year, let us say, is rupees 60 for a dollar. Okay, please note, in this case it would be a divisible number. I mean, you will have to divide, not multiply when you convert. Then the rate on 31st of December 2020, assuming that's the closing of the year, let us say is, so since I want us to have some gain in this example, I'm just exaggerating this to be 75. I'm not saying it will happen, it's just an example. Rupees 75 for a dollar. And the date on which equity was raised, so we raised equity long time back, that rate was rupees 40 for a dollar. The date on which dividend was paid, that rate was rupees 50 for a dollar. You need one more finer piece of information. Opening reserve in USD financials, because with this data there is absolutely no way what is the amount of opening reserve Because that reserve of 40,000 on your balance sheet right now, that is accumulated over the last 5, 6, 7 years. And every year it was in US parents financial statement, it was going at an average rate. So we have to have this amount. Opening reserve in USD is USD 1000. USD 1000. Now with this information, you have to convert financial statement using the current method. Do you want to try? Start. Just round off the numbers. Should we do this together? Alright, so let's start. Equity 20,000 at historical rate. Historical rate was 40. So 20,000 divided by 40, this is 500. Then reserves, Ajit, it was directly given, so you just take it as it is. You don't have to do anything. So these, how have they got this 1000? The historical average rates average. That means all this in Indian rupee we had profit of 40. So every year when that was converted to US dollar over the last few years, that came out to be 1000 US dollars. Is that fine? Then we'll have a CTA number. We don't know how much is that. So we don't do, in fact, hold on a minute. To this reserve, we will also have to add this year's profit. So your this year's profit is 10. Now what a lot of people do is they take the net amount of 8 and do an adjustment there. If you do, it will be a mistake because 10 is to be converted at a different rate, 2 is to be converted at a different rate. So you take 10 and this 10 we should convert at what rate? Average, because everything on your income statement is average. So 10,000 divided by 60, how much? 167. So I'm just saying 167. So that's your profit. Minus dividends. So 2000 and the rate of dividend is how much? 50. So that would be minus 40. Right, and then we will have an adjustment for CTA. We don't know that yet, so I'm going to keep it blank. Then bank loan 110,000, and at what rate should we do this? Current, so that would be 75. So 110 divided by 75, 1467. All assets, you don't have to really get into nitty-gritties because all of them anyways would be converted at current rate. So 170 divided by 75, 2267. So total of your liability side should also be 2267. So this side total should also be 2267. So find out what should be that CTA to make that equation work. So that's 1500, 1627, 23. So it would be how much minus 800? 827. So 827 negative is your CTA. Is it easy? So you first prepare the income statement, then you prepare the balance sheet. So write down somewhere. Current method sequence. Current method sequence. Sequence, first thing that we do is income statement. First income statement, second balance sheet. Is there any part that you want me to repeat again? Do you want me to repeat the entire example again? What doesn't affect cash? So On the balance sheet in Indian rupee, the dividend is already reflected into everything else on the balance sheet. For example, that profit of 10,000, that also affects your reserves, but that profit is already reflected into current year balance sheet. In the same fashion, that dividend is already reflected into current year reserves. But we don't worry because we have opening reserve in US dollar. So you don't have to really worry about that. Had I given you closing reserve, then you don't even worry about the profits. You just calculate CTA, tally your balance sheet. Why did we not convert 40,000 reserves at average rate of 60? Have you earned that entire 40,000 today? Some part of that 40,000 was earned last year, so last year's average. Some part of 40,000 was a year before that, so that year's average. So that 40,000 is in a way converted at an average rate to this 1,000, but that average is average of previous averages. Yes, it has to be. So I'll tell you why the whole of equity is at current rate. These are your assets. Did we multiply entire 170? Did we multiply entire 170 with 75? Yes. Did we multiply this 1,4? Did we multiply did we divide 170 with 75? So in the same fashion, 110 with 75. So then if you don't do that, the balance sheet will never tally. So if you want to cross check, you can do it. So what you do is take 60,000, divide that with 75. Take 60,000, divide that with 75, and then take total of these items. How much? 800. Is it telling? Any questions you want to ask? Do you want to practice one more? So now the subsidiary is in so it is a Russian subsidiary now. So their equity is 70,000, reserves 40,000, bank loan 90, accounts payable 20. So this side total is 110 to 120. On the asset side, we have goodwill 10,000. We have land and bank 200,000, and we have cash 110,000. So again, total 220,000. This was the balance sheet. This is in Russian rubles. Now we have income statement. So we have sales, whatever that is. Profit after tax. Profit after tax 20,000. Dividends 25,000. The historical rate for equity was 45 Russian rubles for a USD. Then the rate for dividend was 70 Russian rubles for a USD. Average rate was 60 Russian rubles, and the rate on 31st of December is 90 Russian rubles for a USD. Opening reserve in US dollars 600. Convert financial statement using the current method, also called as translation method. सुन तो लिया करो मतलब ठीक से पहले. पॉजिटिव या नेगेटिव? Okay, let's do it together now. So all of your assets, they get converted at the current rate. Current rate is 90. So 220,000 divided by 90, how much? 2,444. I'm just mixing. Okay, let's do it separately. So bank loan 90,000 divided by, very nice, 1,000. Accounts payable 2,000 divided by 90, 222. Then your equity gets converted at historical rate. So that's 70 divided by 45. Then opening reserves are anyways given, which is 600. Profits 20,000 divided by average rate is 60, 333. And dividend 25 divided by 25 divided by 70, how much? 357. And then to make the equation tally, the plug figure of CTA to have the total of minus 910 to make the balance sheet tally. Easy?